If you've been holding gold or silver as protection against inflation, currency collapse, or government overreach, the past 4 days just erased months of gains in the most violent precious metals crash since 1980. On Friday, January 30th, 2026, silver plunged 31.4% in a single session, falling from $121 per ounce to $78.53. This marked silver's worst day in 46 years. Gold collapsed 12%, dropping from a record high of $5,680 on Thursday to below $4,900 by Friday's close. Today, February 2nd, gold trades at $4,168 per ounce. Silver sits at $80. The gold-to-silver ratio, which compressed to a historic low of 46.1 just days ago, has now spiked back to 59.1. A move of this magnitude in 72 hours has occurred only twice before. March 1980, during the Hunt brothers silver manipulation collapse, and March 2020, during the COVID liquidity crisis. The trigger wasn't a market crash. It wasn't a banking failure. It was a single nomination, Kevin Warsh for Federal Reserve Chair. The question isn't whether precious metals will recover. The question is, what does the most violent repricing in modern history tell us about what comes next, and which narrative, inflation or deflation, just won the first round? I'm John A.G., and this is the Collapse Files. Between Thursday, January 29th, and Friday, January 30th, 2026, the precious metals market experienced the most catastrophic single-session decline in modern trading history. Gold reached an all-time intraday high of $5,608 per ounce on Thursday morning. By Friday's close, it had fallen to $4,895, a decline of $713, or 12.7%. Silver's move was even more extreme. After touching $121 per ounce on Thursday, a level not seen since the 1980 Hunt brothers squeeze, silver crashed to $78.53 by Friday afternoon. That's a 35.1% decline in less than 30 hours of trading. These aren't normal corrections. Gold's 12.7% single-day drop represents the largest decline since March 1980, when gold fell 15% after the Hunt brothers' silver manipulation scheme collapsed. Silver's 31.4% futures settlement decline marks the worst day since March 17, 1980, when silver fell 34%. The magnitude is only part of the story. The velocity tells us more. Gold moved through 10 standard deviations in 18 hours. In statistical terms, that kind of move should occur once every 3.5 million years under normal distribution assumptions. Silver moved through 12 standard deviations, a theoretical impossibility that signals complete breakdown of market structure. The trigger was President Trump's announcement, leaked early Friday morning, that he would nominate Kevin Warsh as the next Federal Reserve Chairman, replacing Jerome Powell when his term expires in May 2026. Warsh is a former Federal Reserve governor who served from 2006 to 2011. During his tenure, he was known as a monetary hawk, someone who prioritizes inflation control over economic stimulus. He publicly opposed quantitative easing in 2010, arguing that the Fed's balance sheet expansion would create long-term distortions. His reputation as an inflation fighter is well established. The market's interpretation was immediate. Warsh means higher real interest rates, a stronger dollar, and the end of the debasement trade that had driven gold from $2,000 in early 2024 to over $5,600 by January 2026. The dollar index surged 0.8% on Friday, rising from 108.7 to 109.5. That might sound modest, but for a currency index, a 0.8% single-day move is extreme. The 10-year Treasury yield spiked from 4.53% to 4.68%, a 15 basis point jump in one session. Real yields, measured by Treasury inflation, protected securities rose from 2.09% to 2.25%. Rising real yields are mechanical poison for gold. Gold pays no interest. When the inflation-adjusted return on Treasury bonds rises, the opportunity cost of holding gold increases. Investors demanding yield will sell gold and buy bonds. That's exactly what happened. But the move was too large to be explained by yield differentials alone. A 16 basis point rise in real yields typically correlates with a 2 to 3% decline in gold prices. Gold fell 12.7%. That's 4 times the historical correlation. The excess decline was driven by forced liquidation. COMEX gold futures volume on Friday hit 485,000 contracts, 63% above the 30-day average. Silver volume reached 142,000 contracts, 89% above average. Those volume spikes during price collapses indicate panic selling, not orderly repricing. Open interest data confirms this. Gold open interest fell by only 3.8%, despite the massive price decline. Silver open interest fell 5.2%. Normally, when prices crash this hard, open interest drops 15 to 20% as positions are closed. The fact that open interest remained elevated means participants are holding underwater positions, unable to exit without triggering further crashes. ETF outflows accelerated. The SPDR Gold Trust, GLD, saw $1.2 billion in redemptions on Friday alone, the largest single-day outflow since March 2020. The iShares Silver Trust, SLV, recorded $890 million in outflows. These aren't retail investors making minor adjustments. These are institutional liquidations. The CME Group, which operates the COMEX exchange where precious metals futures trade, announced late Friday that it would raise margin requirements effective Monday, February 2nd. Gold margins increased from 6% of contract value to 8%, a 33% hike. Silver margins rose from 11% to 15%, a 36% increase. This was the second margin increase in 3 days. The CME had already raised margins on January 27th in response to the parabolic price surge. The Friday announcement, coming after the crash, signals that the exchange views current volatility as unsustainable and is protecting itself against clearing failures. Margin increases force traders to post additional cash or liquidate positions. A trader holding 100 gold contracts who was margined at 6% suddenly needs to post 33% more collateral. If that cash isn't available within hours, positions are automatically closed. Those forced closings push prices lower, triggering more margin calls. As of today, February 2nd, gold has partially recovered to $4,760 per ounce, still down $840 from Thursday's high. Silver trades at $80, down $41 from its peak. The carnage has moderated, but the damage is done. And the question now is, was this the bottom or the beginning? Precious metals are supposed to rise when governments print money, when fiscal deficits explode, when geopolitical tensions escalate, and when confidence in fiat currencies erodes. Every one of those conditions exists today. U.S. federal debt exceeds $36 trillion. Annual deficits run above $2 trillion. Geopolitical flashpoints multiply from Ukraine to Taiwan to the Middle East. Central banks from China to Turkey to India have been accumulating gold at record rates, and yet gold just fell 15% in 3 days. That tells us the system isn't functioning as designed, or more precisely, it's functioning exactly as designed, but under conditions where positioning and leverage override fundamentals. Here's how the system is supposed to work. Gold serves as a monetary hedge, a store of value when paper currencies lose purchasing power. Silver functions similarly, but with added industrial demand from solar panels, electronics, and medical applications. When central banks create money faster than economic output grows, the purchasing power of paper money declines. Gold and silver, being finite physical assets, should rise in value relative to inflating currencies. That's the theory. In practice, gold and silver trade in highly leveraged futures markets where prices are determined not by physical supply and demand, but by the positioning of speculators, the margin requirements of exchanges, and the opportunity cost relative to interest-bearing assets. Here's the mechanical reality. On the COMEX exchange, a trader doesn't need to pay for an entire gold contract up front. A single gold futures contract represents 100 troy ounces. At $5,000 per ounce, that's $500,000 in notional value. But under the old margin rules, before Friday's increase, a trader only needed to post $30,000, 6% of the contract value. That's 16.7.1 leverage. If gold rises 6%, the trader doubles their money. But if gold falls 6%, the trader is wiped out. And if gold falls 12.7% in one day, as it did on Friday, the trader doesn't just lose their posted margin, they owe the exchange money. When traders can't meet those obligations, the exchange liquidates their positions automatically. Those liquidations happen at market prices, regardless of how low those prices go. If 10,000 contracts need to be sold simultaneously, there's no guarantee of orderly execution. Prices gap, circuit breakers fail, the market becomes a cascading liquidation spiral. Silver's leverage is even more extreme. Silver margins were 11% of contract value before Friday. Each silver contract represents 5,000 ounces. At $120 per ounce, that's $600,000 in notional value, controlled with $66,000 in margin. That's 9.1 leverage, less than gold, but still enough to wipe out accounts in a single violent move. Now let's identify who was trapped and why. First, the momentum traders. Silver had risen from $30 per ounce in mid-2025 to $121 by January 29th, 2026, a 303% gain in 7 months. That kind of parabolic move attracts trend followers, retail speculators, and algorithmic momentum funds. These participants don't care about fundamentals. They care about price direction. As long as the trend is up, they buy. The moment it reverses, they sell. When Warsh's nomination was announced, the trend broke. Every trend-following algorithm triggered sell signals simultaneously. The resulting cascade had nothing to do with silver's industrial demand or monetary properties. It was pure mechanical selling. Second, the leveraged longs who bought near the top. Anyone who bought gold above $5,400 or silver above $110 in the past week is now underwater by 12 to 35%. If they were fully leveraged, using the maximum allowed margin, they're already wiped out. Their accounts have been liquidated. They didn't choose to sell, they were forced to sell. Third, the option sellers. Throughout gold's rise from $2,000 to $5,600, many institutional investors sold call options, bets that gold wouldn't rise above certain levels. When gold kept rising, those options moved deep in the money, creating massive losses for the sellers. To hedge those losses, sellers had to buy gold futures. That buying contributed to gold's parabolic rise. When gold crashed on Friday, those hedges unwound violently. Options that were worth $100 per contract on Thursday were worth $5 on Friday. The sellers who had hedged by buying futures no longer needed those hedges. They sold. That selling accelerated the crash. Fourth, the ETF arbitrageurs. Gold and silver ETFs like GLD and SLV are supposed to track spot prices. When the ETF price diverges from the underlying metal, arbitrageurs step in, buying the cheaper asset and selling the more expensive one until prices converge. But on Friday, the selling pressure was so intense that even arbitrage broke down. ETF prices fell faster than futures prices for brief periods, creating negative arbitrage that forced even more futures selling. The system is designed to allow gold and silver to rise when monetary credibility declines, but it's failing because the participants who dominate price discovery aren't central banks or long-term physical holders. They're leveraged speculators, algorithmic funds, and options market makers. And when those participants are forced to exit positions simultaneously, the system doesn't gradually absorb the selling. It collapses. The CME's margin increase on Friday was an admission of this reality. By raising margins from 6% to 8% for gold and 11% to 15% for silver, the exchange is saying, we no longer trust that current participants can meet their obligations under this volatility regime. That's not market stabilization. That's a clearinghouse protecting itself at the expense of market participants. And when the institution designed to facilitate risk transfer starts rejecting risk, the system has crossed from stressed to broken. Let's examine the numbers that define the most violent precious metals repricing in 46 years. Gold fell from $5,608 on Thursday, January 29th, to $4,195 by Friday, January 30th. That's $730 in 24 hours. Each COMEX gold futures contract represents 100 ounces. A trader holding one contract lost $71,300 in one day. Under the pre-crash margin requirement of 6%, a trader needed $30,000 per contract, 6% to $500,000 notional. A $71,300 loss on $30,000 margin represents a 238% wipeout. The trader doesn't just lose everything, they owe the clearinghouse $41,300 per contract. When thousands of traders face that math simultaneously, liquidations become unstoppable. Silver's move was more catastrophic. From $121 to $78.53 is a $42.47 decline. Each silver contract represents 5,000 ounces. A trader holding one contract lost $212,350 in one session. Under the old 11% margin requirement, a trader posted $66,000 per contract, 11% of $600,000 notional at $120 silver. A $212,350 loss on $66,000 margin is a 392% annihilation. The trader owes the exchange $146,350 per contract. That's not a trading loss, that's financial obliteration. And it happened to thousands of participants simultaneously. The gold to silver ratio moved from 46.1 on January 28th to 59.1 by February 1st. This is critical. When the ratio rises, silver is falling faster than gold. Historically, a rising gold to silver ratio during a precious metal sell-off signals that industrial demand expectations are collapsing or that leveraged silver positions are being liquidated faster than gold. The ratio compression to 46.1 was itself historically extreme. The long-term average gold to silver ratio is approximately 65.1. Ratios below 51 have occurred only during silver manias, 1980, 2011, and briefly in 2020. A ratio of 46:1 meant silver was massively overbought relative to gold. When the Warsh nomination triggered the sell-off, silver's higher leverage and smaller market size caused it to fall faster. The ratio expanding to 59.1 in 3 days represents a 28% increase in the relative value of gold to silver. That's not a gradual repricing. That's a liquidation-driven dislocation. Volume analysis confirms forced selling. On Friday, January 30th, COMEX gold futures volume hit 485,000 contracts. The 30-day average is 298,000. That's a 63% surge. In notional terms, 485,000 contracts represent $242 billion in gold trading in one session, nearly $500 billion changing hands. Silver volume reached 142,000 contracts versus a 30-day average of 75,000. That's an 89% spike. In notional terms, 142,000 contracts at $90 average silver price, midpoint of the session, equals $63.9 billion in one day. For context, the entire annual global silver mine production is worth approximately $30 billion at current prices. The futures market traded more than twice annual global production in a single session. That's not hedging, that's panic. Open interest tells the other half of the story. Gold open interest on January 29th was 512,000 contracts. By February 1st, it had fallen to 492,000, a decline of only 3.9%. Silver open interest fell from 187,000 to 177,000, a 5.3% drop. In normal crashes, open interest collapses as positions are closed. During the March 2020 gold sell-off, open interest fell 18% in 1 week. The fact that open interest barely budged in January 2026 means most traders aren't exiting. They're holding losing positions, hoping for recovery. That creates a ticking time bomb. If gold or silver make new lows in coming days, those underwater positions will be liquidated, creating another cascade. ETF flows provide institutional confirmation. GLD, the largest gold ETF, that represents a 2.4% reduction in holdings in one day. Real yields rose from 2.09% on January 29th to 2.25% by January 31st, a 16 basis point increase. The 10-year Treasury nominal yield rose from 4.53% to 4.68%, a 15 basis point jump. Break-even inflation expectations, the difference between nominal and real yields, fell from 2.44% to 2.43%, essentially flat. Here's what that tells us. The market isn't pricing lower inflation, it's pricing higher real returns on risk-free assets. When risk-free real yields rise 16 basis points in 2 days, the opportunity cost of holding zero yield gold increases dramatically. But, and this is critical, a 16 basis point rise in real yields historically correlates with a 1.5 to 2.5% decline in gold. Gold fell 12.7%. That's 5 times the historical relationship. The gold to silver ratio moved from 46.1 on January 28th to 59.1 by February 1st. This is critical. When the ratio rises, silver is falling faster than gold. Historically, a rising gold to silver ratio during a precious metal sell-off signals that industrial demand expectations are collapsing or that leveraged silver positions are being liquidated faster than gold. The ratio compression to 46.1 was itself historically extreme. The long-term average gold to silver ratio is approximately 65.1. Ratios below 51 have occurred only during silver manias, 1980, 2011, and briefly in 2020. A ratio of 46:1 meant silver was massively overbought relative to gold. When the Warsh nomination triggered the sell-off, silver's higher leverage and smaller market size caused it to fall faster. The ratio expanding to 59.1 in 3 days represents a 28% increase in the relative value of gold to silver. That's not a gradual repricing. That's a liquidation-driven dislocation. Volume analysis confirms forced selling. On Friday, January 30th, COMEX gold futures volume hit 485,000 contracts. The 30-day average is 298,000. That's a 63% surge. In notional terms, 485,000 contracts represent $242 billion in gold trading in one session, nearly $500 billion changing hands. Silver volume reached 142,000 contracts versus a 30-day average of 75,000. That's an 89% spike. In notional terms, 142,000 contracts at $90 average silver price, midpoint of the session, equals $63.9 billion in one day. For context, the entire annual global silver mine production is worth approximately $30 billion at current prices. The futures market traded more than twice annual global production in a single session. That's not hedging, that's panic. Open interest tells the other half of the story. Gold open interest on January 29th was 512,000 contracts. By February 1st, it had fallen to 492,000, a decline of only 3.9%. Silver open interest fell from 187,000 to 177,000, a 5.3% drop. In normal crashes, open interest collapses as positions are closed. During the March 2020 gold sell-off, open interest fell 18% in 1 week. The fact that open interest barely budged in January 2026 means most traders aren't exiting. They're holding losing positions, hoping for recovery. That creates a ticking time bomb. If gold or silver make new lows in coming days, those underwater positions will be liquidated, creating another cascade. ETF flows provide institutional confirmation. GLD, the largest gold ETF, holds approximately 890 tons of gold. On Friday, January 30th, the fund saw outflows of 8.2 tons, $1.2 billion at Friday's average prices. For comparison, GLD saw inflows of 45 tons in the first 3 weeks of January. The reversal is violent and sudden. SLV, the largest silver ETF, holds roughly 14,200 tons. Friday's outflows totaled 340 tons, $890 million. That represents a 2.4% reduction in holdings in one day. Real yields rose from 2.09% on January 29th to 2.25% by January 31st, a 16 basis point increase. The 10-year Treasury nominal yield rose from 4.53% to 4.68%, a 15 basis point jump. Break-even inflation expectations, the difference between nominal and real yields, fell from 2.44% to 2.43%, essentially flat. Here's what that tells us. The market isn't pricing lower inflation, it's pricing higher real returns on risk-free assets. When risk-free real yields rise 16 basis points in 2 days, the opportunity cost of holding zero-yield gold increases dramatically. But, and this is critical, a 16 basis point rise in real yields historically correlates with a 1.5 to 2.5% decline in gold. Gold fell 12.7%. That's 5 times the historical relationship. The divergence indicates that fundamental repricing accounts for maybe 2% of the decline. The other 10% is forced liquidation, leverage unwind, and positioning capitulation. The dollar index rose from 108.7 to 109.8 between January 29th and February 1st, a 1% gain. Historically, a 1% dollar rally correlates with a 0.8 to 1.2% gold decline. Gold fell 12.7%, again 10 times the historical relationship. Every data point, leverage ratios, volume spikes, minimal open interest reduction, ETF outflows, and correlation breakdowns, points to the same conclusion. This was not a fundamental repricing of gold's value relative to interest rates or dollar strength. This was a forced liquidation of the most crowded long trade in global markets, triggered by a policy signal that shifted expectations about the Fed's future path. The fundamentals that supported gold at $5,600, fiscal deficits, geopolitical chaos, central bank buying, haven't changed. What changed was the market's belief about whether the Federal Reserve would allow those fundamentals to manifest in higher inflation or force them into a deflationary debt collapse through higher real rates. Friday's price action was a vote for the latter. Whether that vote is correct remains to be seen. But the violence of the repricing tells us the market had positioned for the opposite outcome and got caught completely wrong-footed. Violent, politically triggered precious metals crashes have occurred 3 times in the past 50 years under circumstances that provide a roadmap for what typically happens next. The first was March 1980, following the Hunt brothers' attempt to corner the silver market. Nelson Bunker Hunt and William Herbert Hunt, heirs to an oil fortune, began accumulating silver in 1973. By 1980, they controlled nearly 1/3 of the world's deliverable silver supply. Their buying drove silver from $6 per ounce in January 1979 to $50 by January 1980, a 733% surge in 12 months. On January 7, 1980, COMEX raised margin requirements from 10% to 100% and banned new speculative long positions, a move designed explicitly to break the Hunt brothers. On March 27, 1980, silver collapsed from $21 to $10 ADU in a single session, a 48.6% decline. It marked Silver Thursday, the day the Hunt brothers' empire collapsed and nearly brought down several major banks. Gold also crashed, falling from $850 in January 1980 to $470 by March, a 45% decline in 2 months. But gold's crash had a different driver. Paul Volcker, the Federal Reserve Chairman, had begun raising interest rates aggressively to crush inflation. The federal funds rate reached 20% by mid-1980. Real yields spiked. Gold, which had been a hedge against 1970s inflation and dollar debasement, lost its appeal as Treasury bonds suddenly offered double-digit real returns. The lesson from 1980, when central banks credibly commit to crushing inflation through higher rates, gold crashes regardless of how much money has been printed. The 1980 crash lasted 2 decades. Gold didn't recover to $850 until 2008. The second precedent was September 2011. Gold had risen from $250 in 2001 to $920 by September 2011, a 668% gain driven by post-2008 quantitative easing, zero interest rates, and fears of dollar debasement. Silver had surged from $4 in 2001 to $49 in April 2011. On Sunday, April 24th, 2011, silver opened in Asia and immediately crashed 13%, the Sunday night massacre. Over the following week, silver fell from $49 to $30, a 33% collapse. The trigger was a CME margin hike, the fifth in 2 weeks. Gold followed, falling from $1,920 in September 2011 to $1,550 by December, a 19% decline. The deeper cause was Fed policy shift. In mid-2011, the market began anticipating the end of QE2 and a potential shift toward rate normalization. Real yields bottomed in 2011 and began a multi-year rise. Gold entered a bear market that lasted until 2016, falling as low as $150. The lesson from 2011: margin hikes don't kill bull markets by themselves. They kill bull markets when the underlying monetary policy narrative shifts from easing to tightening. The 2011 crash correctly anticipated that the Fed would tighten policy, though that tightening didn't actually occur until 2015. The third precedent, more mechanical than political, was March 2020. As COVID lockdowns began, gold fell from $1,680 on March the 6th to $1,450 on March 16th, a 13.7% decline in 10 days. Silver crashed from $18 to $12, a 33% collapse. The crash occurred despite the Fed cutting rates to zero and announcing unlimited QE. Why? Because leveraged participants needed cash immediately to meet margin calls in equity and credit markets. Gold and silver, being the most liquid assets, were sold first. This was pure liquidation, unrelated to monetary policy. Gold bottomed on March 16, 2020, and rallied to $2,070 by August, a 42% surge in 5 months. Silver surged from $12 to $29, a 142% gain. The reversal was driven by the market realizing that the Fed's response would be massively inflationary in the long term. The lesson from 2020: liquidation-driven crashes reverse violently once forced selling exhausts and fundamentals reassert. Now, apply these patterns to January 2026. We have elements of all three precedents. Like 1980, we have a hawkish Fed chair nominee signaling higher real rates to combat inflation. Like 2011, we have massive margin hikes and a narrative shift from inflation will run forever to the Fed will credibly fight it. Like 2020, we have forced liquidation from leveraged positions. If this is 1980, gold could fall another 20 to 30% and stay depressed for years. If this is 2011, we're in for a multi-year bear market with periodic rallies that fail. If this is 2020, the bottom is already in and a violent reversal is imminent. The determining factor is whether Warsh's nomination represents a credible regime change toward monetary discipline, or whether it's political theater that will collapse under the weight of $36 trillion in federal debt and $2 trillion annual deficits. We won't know until Warsh is confirmed, takes office in May, and begins making actual policy decisions, but the market has already placed its bet. And the violence of Friday's repricing suggests that bet was heavily one-sided. The mainstream narrative frames this crash as a simple response to Warsh's hawkish reputation and rising real yields. That explanation is not wrong, but it misses the larger structural story. What most analysts overlook is that gold's crash reveals the complete failure of the debasement trade thesis that dominated 2024 and 2025. For 2 years, the narrative was simple. Governments are printing unlimited money, fiscal deficits are exploding, central banks have lost control of inflation, and fiat currencies are being debased into worthlessness. Therefore, own hard assets: gold, silver, Bitcoin, real estate, commodities. That narrative drove gold from $2,000 in early 2024 to $5,608 in January 2026, a 180% gain. It drove silver from $23 to $121, a 426% surge. Chinese retail buyers lined up to buy gold jewelry. Indian central bank reserves hit record levels. Turkey, Russia, and emerging market central banks accumulated gold at the fastest pace since the 1960s. All of those fundamentals remain true. U.S. federal debt is still $36 trillion. Deficits still exceed $2 trillion annually. The Fed's balance sheet is still $7.2 trillion. Fiscal discipline has not been restored. Currencies have not been strengthened. And yet, gold crashed 15% in 3 days. What changed was the market's belief about which force would dominate: inflationary debt monetization or deflationary debt collapse forced by higher real rates. In 2024-2025, the market assumed inflation would dominate. In January 2026, Warsh's nomination shifted expectations toward deflation. The market now believes the Fed will prioritize inflation control even if it breaks credit markets, triggers recessions, or forces sovereign debt crises. That's a massive regime change. And regime changes don't happen gradually. They happen in violent 3-day purges that wipe out everyone positioned for the old regime. The second thing most people miss is the role of narrative control and the timing of the Warsh nomination. Gold hit an all-time high of $5,608 on January 29th. Silver hit $121. By January 30th, the very next day, Trump announced Warsh's nomination. The timing was not coincidental. When gold rises sharply, it sends a political signal. People are losing faith in the dollar. Central banks are losing credibility. The monetary system is unstable. For any administration, a surging gold price is a vote of no confidence in economic policy. By nominating a hawkish Fed chair the day after gold hit a record high, Trump sent a countersignal. We will restore dollar credibility. We will fight inflation. We will defend the currency. Whether Trump actually believes this, or whether Warsh will actually implement hawkish policy, is irrelevant in the short term. What matters is the narrative shifted, and that shift triggered liquidations. The third overlooked factor is the incentive structure of central banks and sovereign holders. Central banks that accumulated 1,000 plus tons of gold in 2024, 2025, China, Russia, Turkey, India, are not selling. They're strategic buyers with multi-decade time horizons. They don't panic sell on a 15% correction, but they're also not buying aggressively right now. Why? Because if you're already heavily positioned in gold and it's falling, adding to the position while it's in free fall makes no sense. You wait for stabilization, then you buy. This creates a vacuum. The natural bid from central banks, which supported gold throughout 2024-2025, has temporarily disappeared. Speculative sellers are overwhelming the market, and there's no offsetting strategic bid to absorb it. That vacuum can last weeks or months, and during that time, prices can fall much further than fundamentals justify. The fourth missed factor is the futures curve structure and its implications for ETF holders. Gold futures entered backwardation in late 2025, meaning near-month contracts traded at a premium to deferred contracts. Backwardation signals tight physical supply and high near-term demand. As of February 1st, 2026, gold futures have shifted into contango. Deferred contracts now trade at a premium to near-month. The April 2026 gold contract trades $22 above the February contract. That's a structural shift from scarcity to abundance, from tight supply to ample supply. For ETF holders, contango creates a hidden cost. ETFs like GLD roll their futures exposure monthly, selling the near contract and buying the deferred contract. In contango, that roll means selling low and buying high, an implicit loss that compounds over time. Most retail investors don't understand this. They see gold prices falling and assume they can wait it out. They don't realize the ETF structure is slowly eroding value, even if spot prices stabilize. The final overlooked element is who benefits from this crash. Commercial banks and bullion banks, the institutions that provide liquidity to the gold market, were massively short gold, and silver into the January highs. When prices crashed, those shorts became hugely profitable. The same institutions that lost billions as gold rose from $2,000 to $5,600 just made it all back in 3 days. This isn't market manipulation, it's market structure. Liquidity providers hedge their exposure by taking the opposite side of speculative positions. When speculators are overwhelmingly long, liquidity providers are short. When the crash comes, the longs get obliterated and the shorts profit. That dynamic creates a self-reinforcing cycle. The higher prices rise on speculative buying, the more shorts build up, and the more violent the eventual crash when liquidations begin. The January 30th precious metals crash is not a signal about gold or silver. It's a signal about policy credibility, market structure, and the fragility of consensus narratives. The fundamental case for owning gold, fiscal irresponsibility, monetary debasement, geopolitical chaos, has not weakened. It has strengthened. U.S. fiscal deficits remain above $2 trillion. Debt service costs now exceed defense spending. Geopolitical tensions are escalating from Ukraine to Taiwan to the Middle East. Central banks continue accumulating gold reserves. But the market is signaling that those fundamentals will be overwhelmed, in the near term, by a Federal Reserve that's willing to break markets to restore credibility. This creates a dangerous divergence. When price action diverges from fundamentals, one of two things happens. Either price snaps back to fundamentals violently, or fundamentals were misunderstood and the new price is correct. History suggests the former is more likely. Every major precious metals bear market of the past 50 years, 1980, 2001, and 2011, 2015, occurred when the Fed credibly committed to fighting inflation through higher real rates. But both bear markets ended when that commitment proved unsustainable. In 1980, Latin American debt crises and the savings and loan collapse forced rate cuts. In 2011, the European sovereign debt crisis and persistent deflation forced QE resumption. The current setup is similar. Real yields are rising because markets believe Warsh will prioritize inflation control. But that belief assumes Trump's fiscal policies. Tariffs, deficit finance tax cuts, reduced immigration won't reignite inflation. It assumes global debt levels can withstand higher rates without triggering cascading defaults. It assumes the Fed has the political and economic space to maintain tight policy for years. Those are heroic assumptions. The warning this crash delivers is about timing, not direction. Gold will not protect portfolios in the early stages of a policy regime change. It protects in the late stages, after the new policy fails or produces unintended consequences. We are in the early stage now. Warsh hasn't been confirmed. He hasn't taken office. He hasn't made a single policy decision. Yet the market has already priced in years of hawkish policy. If that pricing is wrong, if Warsh proves less hawkish than expected, or if economic conditions prevent him from implementing his preferred policy, the reversal will be catastrophic for those who sold at current levels. The second warning is about liquidity and market structure. Gold's 15% crash in 3 days was driven by forced liquidation from leveraged positions. Forced liquidation indicates that liquidity, the ability to exit positions without moving prices, was far thinner than anyone realized. Thin liquidity means future volatility will be extreme. It means position sizes must be smaller and time horizons longer. It means stop losses will be run through without fills. It means markets can gap in ways that wipe out accounts before participants can react. For anyone holding gold or silver as insurance, the message is clear. Insurance premiums are cyclical. Right now, the market is saying insurance is overpriced. But insurance isn't overpriced because the risk disappeared. It's overpriced because everyone bought it simultaneously, and now everyone is selling it simultaneously. When consensus is this one-sided, when everyone believes Warsh will save the dollar and restore Fed credibility, the probability of that consensus being wrong approaches certainty. Consensus trades don't fail gradually. They fail in 3-day collapses that leave no survivors. Gold's crash isn't signaling that fiscal and monetary risks have disappeared. It's signaling that the market believes those risks will be managed. If that belief is proven wrong, the repricing will make January 30th look like a warm-up. Gold and silver did not crash because the risks they hedge against have disappeared. They crashed because the market decided those risks will be controlled by a Federal Reserve chair who prioritizes credibility over accommodation. That decision is based on a nomination, not evidence. Warsh has not been confirmed. He has not taken office. He has not set policy. The market is pricing a best-case scenario where a hawkish Fed successfully restores dollar credibility without triggering debt crises, without breaking credit markets, and without forcing political intervention. That scenario is possible, but it requires assumptions that history suggests are unlikely to hold. The 1980 precedent suggests gold could fall further and stay depressed for years if Warsh truly implements Volcker-style tightening. The 2011 precedent suggests a multi-year bear market if the Fed's hawkish rhetoric is sustained. The 2020 precedent suggests the bottom is already in if this was pure forced liquidation that will reverse once fundamentals reassert. We don't know which path we're on. But we know leverage has been purged, weak hands have been eliminated, speculative positioning has been reduced. These are necessary preconditions for a bottom, but not sufficient ones. The fundamentals supporting gold, currency debasement, fiscal chaos, geopolitical instability remain intact, but fundamentals don't determine short-term price action. Positioning, narrative, and liquidity do. Right now, positioning is bearish. The narrative is dollar positive. Liquidity is thin. The combination can persist for months. The question isn't whether gold will eventually rise. The question is whether you're positioned to survive the wait without being forced to sell at the worst possible time. Because when gold bottoms after a politically driven crash, driven by a Fed leadership change, the rally that follows doesn't wait for confirmation. It doesn't wait for consensus. It just begins, violently without warning, leaving behind everyone who sold into the panic.